difficult position, a situation that many central bankers around the world are facing. And you wrote recently that you thought rate cuts were a long way off. And I'm wondering if you could explain to us what that means to you. What is a long way off, and what are you looking for before there might be cutting in the UK?
Yeah, thank you. Look, the UK, to my mind, if you compare it with other developed economies, stands out in a few different ways. One is the supply side of the economy is really constrained, particularly relative to the US. So it's fairly weak, which means that if you have a lot of demand, that's inflationary. But it turns out the demand side of the economy is pretty weak as well. And so what I'm looking at is these indicators of persistence of inflation. We've been above our 2% target for a pretty long time. And the concern is always that you get second round effects, wage catch up, inflation expectations remain elevated. And so I'm concerned about those things. And there are some indications that there's more persistence of inflation in the UK than there is in other countries. Specifically, I'm looking at wage growth data. So we just got some out a few days ago. Average pay for the private sector is growing by about 6% year on year. That's pretty high. It's been moving in the right direction. But just by way of example, wage growth in the UK, depending on what metric you look at, is around 6 to 7%. In the US and the Eurozone, it's around 4 to 5.5%. So wages are sticky, and so that's an indicator that I'm looking at. Also services inflation, so wage growth is a big input into services inflation, and services inflation has been elevated in the UK as well. So what we saw with the most recent inflation data was that it came down. It surprised on the upside a little bit. Yeah. Actually, that was driven by services inflation. If you look at the components of that, actually rents were a big piece of that, and they tend to be pretty volatile. So I like to look at more metrics of core services inflation, stripping out things like rent, tourism-related sectors to get a better sense of what's happening in the domestic economy without these volatile things. And it's coming down. Again, it's been moving in an encouraging direction, but to my mind, it still remains too high. So, if you have high wage growth and services inflation that's sticky, productivity growth of around 1%. The numbers that we're seeing in terms of wage growth and services inflation just aren't consistent with a sustainable 2% inflation target, which is what we're trying to hit.
And it sounds like, hearing you, that that's outweighing in your mind some of the unemployment numbers, some of the labor market itself. The wage growth feels to you that it's going to keep inflation above target longer.
Yeah, so the labor market's tricky. We've had some data issues in the UK that makes it harder to read, but we look at a whole bunch of different indicators to try to get a complete visibility on the labor market. And we know that vacancies have been coming down, so the labor market has been loosening, but it still remains pretty tight. And to my mind, this is one of the biggest puzzles in the UK, but also in other developed economies. How are we having pretty weak growth because in part of high rates, but the labor market's still really strong and wage growth is still really strong. In my mind, it could be labor hoarding. That could be one of the explanations, which poses a risk for central bankers, because if we don't see an uptick in activity, firms might decide to stop labor hoarding, lay off a whole bunch of workers. That would be a risk on the downside, and then central banks would have to act.
And are the things that are keeping inflation sticky, you touched on this a little bit, are they idiosyncratic to the UK? Because obviously we have sticky inflation here in the US. We had our own higher than expected CPI and PCE data come out. But you mentioned some things that feel a little more UK specific.
Well, it's higher in the UK. I think part of the reason the UK had this kind of double whammy of an energy shock in terms of trade shock, like what Europe experienced, alongside a really tight labor market like the US experienced. And those things, two things together, I think, have kept wage growth pretty buoyant. Some research suggests that in the face of an energy shock, inflation expectations tend to be more backwards looking. So people end up getting an idea about where inflation is going based on what they've just experienced. And so people tend to be more sensitive to the original shock. We had this massive energy shock in the UK, which, for example, the US, a net energy exporter, didn't experience. So that's been a piece of it, I think.
Can I ask you, and this is a question we talked to the Fed about as well, the risk of waiting too long and how you balance getting toward the inflation target versus hitting the inflation target? You know, what are you looking for on that trajectory to say we're headed towards it and I don't want to wait too long to start cutting for the transmission of monetary policy?
Yeah, so this is the trick, and has been the trick over the past couple of years with all these unprecedented supply shocks, that you're really relying on your forecast, right? You can't look at the data today to figure out what you should do for policy because it takes a while to transmit through the markets and into the real economy. We've done a lot of work actually on the monetary transmission mechanism, and have found that it actually doesn't seem to be operating much differently from what we've seen in the past, even though the structure of the mortgage market has changed pretty significantly in the UK. Now most people are into 2- and 5-year fixes, which wasn't the case before the global financial crisis, for example. So, you know, that hasn't changed dramatically, but you're right. We have to weigh the risk of doing too much against the risk of doing too little. Unlike in the US, where growth is really strong, it's not in the UK. We just had a technical recession, though the labor market is so tight. I'm not sure I would really count that as a recession. There are indicators that we've already come out of it. But it does mean we're sort of in trade-off territory in terms of, you know, supporting inflation or growth. Now our mandate is to, of course, focus on inflation, and subject to that, to look at the government's objectives in terms of growth. In my mind, one of the biggest lessons we learned from the 70s and 80s was that stop-start monetary policy doesn't tend to end well, and so. Of course, I'd like to thread the needle perfectly.
That's a good UK pun, thread needle.
Yeah, that's right. That's right. But you know, if we can't do that, do I think it's worse to do too much or worse to do too little? And I think actually doing too little is the bigger risk, because you end up having to hike rates even higher in the end and could end up generating an even bigger recession. That would be the worst scenario.
It's interesting you say start, stop. So what I'm hearing is when you're ready to start cutting, that should be a cycle of cutting. It's not a cut, then pause and see. This has been a debate we're having here in the US as well.
Yeah, so I wouldn't say that actually. I think it really does depend on the data and how it influences our forecasts. I would say though, you know, the Fed back in the 80s thought inflation was under control, cut rates, and then actually had to completely reverse and hike rates. So that's what we're trying to avoid. I wouldn't suggest that, you know, once we start cutting, it will just be kind of a consistent every meeting type of thing. That's not the case at all. We're very data dependent.
So I'm just looking at the WEO, to your point, UK growth projected now at 0.5% in 2024 from the numbers that came out yesterday.
That's right, and that's roughly in line with our forecast. If you look into the details of our forecast, that's driven mostly by government spending, so the market sector. The private sector is actually mostly a drag on growth. So that's a pretty weak picture. We have it, you know, growth picking up more over the course of the forecast period. I should say, given our focus on inflation, we expect inflation to come to target over the next couple of months. But I don't think that's worth kind of breaking out the ticker tape. We don't think it will stay there. We think, and we need to have inflation sustainably at target. So we expect an uptick after we hit the target.
That's interesting. What drives the rebound then on inflation? Is it the issues you were raising
So,
at the beginning?
yeah, most of the heavy lifting in inflation coming down over those couple of months is being done by energy costs, which are dragging because of base effects, and those drop out. So in our view, core services and goods inflation sort of outweigh the implications of energy over the second half of this year.
Final monetary policy question I'll ask you, and then we'll move on to geopolitics and China and other issues. Long way, which you said in the FT column, which I recommend to everyone to read. By the way, central bankers don't often communicate as clearly as you have, and credit to you for doing that both here and in the FT and otherwise. But what does a long way mean? Because that's open to interpretation.
It is open to interpretation. It means that, you know, in my mind, I don't think it's imminent. As I said, I'm focused on wage growth and services inflation, and they're going in the right direction. I just don't think they're going at the speed I'd like to see them. And also, I just want to wait and see more progress in the direction that we're looking for before I feel confident in cutting rates. Ultimately, we know we're in restrictive territory, and I think we're going to need to stay there for a while.
Okay. Thank you. That's very helpful. Let's talk geopolitics a little, which impacts monetary policy as well, but is broader than that. It's an era of shocks we're living in. COVID, Russia's illegal invasion of Ukraine, war in the Middle East. I wonder, you as a central banker try to anticipate, prepare, deal with these shocks. You talked about energy prices and the ripple effects of that, but it's a new era we're in, and I think it calls on something different than central bankers have probably been accustomed to in the past.
Yeah, particularly geopolitical shocks. They're very difficult to forecast, the timing of it, the choreography. So we certainly consider these things. For example, we've spent some time looking at the Red Sea and what that might do to shipping times and shipping costs and how that might impact inflation. So we do spend some time looking at that. But it is a much more uncertain era that we're in, I think, than what we had previously.
And are there other, as you think about what happened over the weekend, Iran's attack on Israel, I mean, does this recalibrate a little energy forecast, or it's just a constant evolving process you're trying to go through?
Yeah, so I'm not going to pretend to be a Middle East expert, but of course I'm concerned about what's happening in the Middle East for a host of reasons, but also for the implications, potential implications on energy prices. So far, you actually haven't seen significant moves in oil prices, which to my mind is a bit of a surprise. I mean, markets exist to price risk, and the risk is really only on one side with this, but I think part of that might be an assumption that it's in nobody's best interest to have an escalation. That could be part of it. But I think this poses a risk for the UK economy. We've already come through an energy shock and a terms of trade shock. To have another one would put upward pressure on inflation again, and could also risk de-anchoring inflation expectations. As I mentioned, in the face of an energy shock, inflation expectations tend to be more backward-looking and sensitive to that shock. So that it would undo some of the work that we've been doing and would pose a challenge for us.
One thing that surprised several people, we were talking about this yesterday in the WEO, is that IMF projects commodity prices, including oil prices, coming down over the next 6 months to a year. And again, the WEO gets done weeks ago, but given the events of the past few weeks, it feels like that might need to be reforecast.
It's tricky. For us, in terms of our forecast, it's a conditional forecast for what it's worth, and it's conditioned on market rates, and market implied rates for a whole bunch of things, for interest rates, but also for commodity prices.
Yeah, that makes sense.
Yeah.
I know you can't speak about other central banks' policies, so I won't ask you about that, but the dollar more broadly, the Fed is going to keep presumably interest rates higher for longer than expected. That means a strong dollar, and that has ripple effects all over the world, advanced economies, emerging markets. I'm wondering how you see that issue playing out, because 6 months ago, this is not what was expected.
Yeah, that's right. I mean, it has implications for a small open economy like the UK. The UK will effectively be importing inflationary pressures as a result, and we do a lot of trade with the US. So there will be broader implications. I think the bigger implications could be for emerging markets, particularly those that have been invoicing trade in US dollars and issuing debt in dollars. So I think that there are some concerns there as well.
So I'm going to ask you to put on your macroeconomist hat. We'll move a little away from monetary policy, but China, Secretary Yellen was there 2 weeks ago, really hammering home this point about manufacturing overcapacity. This issue has been building for several months, but she made it a key theme of her visit. It's coming up throughout this week in Washington during the meetings. And there's a debate, how much of this is typical of China's industrial policy and how they have operated for decades, and how much of this is a surge that's new given deleveraging in the property sector. And I'm wondering how you see the pressures that are coming in the exports specifically from China in the years ahead.
Yeah, so I think industrial policy is kind of the name of the game, not just in the U.S., but across the developed world, also in China. China's growth model is having to shift. So unfortunately, I'm going to give you a very two-handed answer and say it's probably a little bit of both. Yeah. The property sector hasn't rebounded as I had expected it to, actually, when the government provided some stimulus measures. There seems to be a floor under it, but that's very different from a rebound. And I think Communist Party members have been very clear that they have kind of a longer-term strategic goal to rebalance the economy away from investment towards spending. And they've also, in the past, pulled on all traditional levers to reflate growth when they've needed to. They're not doing that now. They're not pulling on the property lever. And so I do think that they are pivoting, and partly that's to the manufacturing sector. So I think it's a bit of both. I, as you know, have believed that the whole deglobalization narrative is a bit overblown. It still makes sense for a lot of companies to be hooked in, American companies to be hooked into a Chinese supply chain. It's sophisticated, it's efficient, But I do think we're seeing less globalization, and I'm surprised by how much that hasn't come up in conversations here, and I think it's because it's less of a risk now and more of a base case.
Compared to 6 months ago or a year ago, the amount of deglobalization talk, you would say, is different.
That's right. And again, I don't think it's because everybody's lost sight of it.
Right.
I think it's actually just sort of an accepted development rather than a risk.
Well, what about industrial policy back on the U.S. side? You
Yeah.
referenced that. I mean, President Biden announced yesterday tripling of steel and aluminum tariffs when it comes to China. It's an interesting contrast to me, those kind of announcements during IMF World Bank Week, which is supposed to be about spirit of Bretton Woods and international economic multilateralism. Right. What kind of risks does that present?
I mean, I think industrial policy means that you sort of give up on growing the pie overall and instead focus on distribution of it. And as an economist, I don't like that shift generally. But it does seem that no matter what the outcome of the U.S. election, we will have some version of industrial policy. It's less efficient. It could be more resilient. I have to say I was a big skeptic of manufacturing jobs coming back to the U.S. off the back of legislation. But if you look at the data, it's actually played out. And so, there has been some reshoring of manufacturing. It hasn't been a massive investment, public and private stimulus for the U.S. over the past year or two. So a lot of the fruits of this that the Biden administration was looking for have actually happened.
Yeah, no, that's been surprising, I think, to a lot of us who have studied this, who have shared a similar skepticism. But the data is the data, and it has jumped more than a lot of people expected. I want to talk about Japan. I mean, you've written about Japan extensively over the years. We've all read your writing, and I won't ask you to talk about the BOJ specifically, but they're in an interesting era right now, changing from where they've been before. Obviously, dollar has ripple effects for them as well, but the major shifts underway, not just with the yen, but the Japanese economy more broadly.
It's true. To my mind, I wrote a column on the Bank of Japan giving up yield curve control over a year ago at this point. So it's not that it was a shock that the Bank of Japan actually ended up doing this. But still, I'm surprised by how orderly the markets responded to it. At the time, the Bank of Japan was considered the last central bank to really ground rates, so that they were low. And if the Bank of Japan hiked rates or gave up yield curve control, the concern was that actually rates would be destabilized everywhere. That hasn't happened actually at all. So I do think signaling has helped, and they've pulled it off. There are currency implications. The yen always behaves differently from the dollar, for example. But the inflation data in Japan has been encouraging to allow the Bank of Japan to unwind some of its, special monetary policy.
And so now I'm promised I was done with monetary policy, but I'm not done with Bank of England, so I'm going to come back a little. I'm very curious. I'm not sure that everyone understands what it means to be an external member of the policy committee. This is not a situation that every central bank in the world has, and just if you could explain that to everyone, how this works, the structure, your role in voting.
Yeah, sure. So the Bank of England is pretty different in its institutional setup in that the Monetary Policy Committee has 9 members. 5 are internal members, and 4 of us are external members. The internal members sometimes grow up at the Bank of England, sometimes not. The external members, though, are brought in quite intentionally from the outside. So you can tell from my accent that I'm not, I don't sound British. I am actually British as well. But 2 of us as external members hail from the U.S., but also it's a matter of hailing from different sectors. So just to round out the committee, and also to make sure that there isn't really any groupthink going on. So, the external members have their own staff. We all draw from a pool of about 200 economists, the internal members and the external members. They support us all. We all have the same vote. They all weight the same, and we have to claim our vote, which is different at the Bank of England as well. So you know exactly how I voted every time. You don't know how every FOMC member's voted.
Oh, so that's known how you voted.
Yep.
How was it broken down in terms of unanimity or dissent over the last 6-7 months that you've been on the committee?
Yeah, so I've dissented about half the time that I've been on the committee. It's not abnormal to dissent on the MPC, which is again different from how other central banks operate. Often, clearly some people might disagree at other central banks, but there's generally one voice that's provided. At the Bank of England, all of our votes are on the record. You know how everybody's voted. I think it gives us accountability, which I think is a positive.
And so now being here at the IMF World Bank meetings, you've done this many times, but in a different role. Is it different coming back as a central banker to the IMF World Bank Spring Meetings versus a macroeconomist?
It is I'm not used to getting so many questions about the UK labor market when I was a global economist and covered the whole world. So it is certainly different, but I also think the UK is a small, open economy, and so it's really important that people like me get the perspective and join in international gatherings like these, just to get a sense of kind of what the biggest issues are and what's coming up ahead that we need to look out for in terms of our own forecasting, figuring out what's happening with growth for the UK and inflation.
So I want to take one or two online questions before we wrap up. So I asked you about interest rates, but this is a question about QT, quantitative tightening.
Okay.
The track that you see in quantitative tightening, UK Parliament has been critical when this started. They called it a leap in the dark. You've said that the bank must move slowly and quite deliberately on it. So what are you looking for on the QT path, and do you expect more QT in 2024?
Yeah, so the MPC votes on QT every fall for the next year, and then what we're planning on doing is transmitted to the market. So it's all very transparent. Investors know exactly what they're going to have to absorb. And we have kind of a knockout clause at the Bank of England, whereby it's one of the guiding principles is that we don't do it if it's disrupting markets and generating market stress. So that is kind of an automatic pressure release. And so we've seen that play out, for example, in the gilt crisis, the LDI crisis in the fall of 2022. That's one example. And so if that's a condition for doing QT, then I do think we need to go slowly and deliberately, but I feel more comfortable about it knowing that that's a condition. If we see significant market stress, then we'll pause it or delay it. So that's one thing. We'll vote again in the fall. We don't know no one knows the perfect number of reserves to have out there. We don't want to generate scarcity of reserves. And so we have some estimates, and those estimates suggest that depending on what we decide in the fall, it's possible we could hit kind of the upper bound of those estimates over the next year and a half. So, I do think that we'll need to look at this. We all remember the repo rate spike in the US. It's something we're keen to avoid. We don't want to generate a scarcity of reserves. But we also have a short-term repo in the UK that also provides some relief. To my mind, the concern is not in the banking sector. Actually, it's in the shadow banking sector because we don't regulate shadow banks. And so if there is stress there, we can lend to them through the banks. And that works as long as the banks want to lend. And if not, I do think counterpart eligibility with the short-term repo is limited. It's not just the Bank of England's issue. Actually, everyone's in this position. So that provides a risk. But it is all transmitted. It's done very deliberately and slowly.
Can I ask you, since you raised the gilt crisis, lessons learned, that we're past a year and a half, how the Bank of England process, they stepped in, immediate reaction, but obviously I'm sure there's been debriefs and stock taking on what to do, and we hope situations avoided in the future. But how you think about that internally at the Bank of England?
Yeah, so I think the biggest lesson learned from that is that you can actually use the balance sheet in a targeted, timely, and temporary way. And it worked quite successfully. So, up until the LDI crisis, every time a central bank had stepped in with its balance sheet, it was in kind of this shock and awe in response to a massive crisis, open-ended way. And there's a signaling effect, and it's understood that that's partly how QE works, right? But this time around with the LDI crisis, it really was done in a timely, targeted, temporary way. And there were concerns about whether that would be successful, but it was.
Yeah. So final question, we're almost out of time, but just what is it you're trying to achieve this week from the Bank of England perspective at the meetings? Is there goals you have, or is it talking and learning and hearing back on others' perspective on the UK's economy?
Yeah, so it's a bit of both, trying to explain sort of where I am in events like this, for example, how I'm viewing the evolution of the UK economy and inflation. But it's also a question of just listening and learning, particularly from those outside the UK, so that I can get a sense of what the main concerns are amongst sort of the global intelligentsia.
Megan, thank you for coming back to the Council. Thank you for being a partner over many years. We congratulate you on the new role, because we haven't seen you in Washington since. I know it's not so new anymore. We wish you the best of luck, and we look forward to checking in as the situation evolves in the UK.
Thank you so much.
Thank you all for being with us. In 2 hours, we'll host the EU Commissioner for the Economy, Paolo Gentilini. Please join us back at the Atlantic Council headquarters for that. This afternoon at our broadcast center inside the IMF, we have a series of analytical events and finance ministers. You can check out the full agenda on the Atlantic Council website. We wish everyone a pleasant rest of the day.